my name is Maya Sybil, and I am a reporter and content producer at insuranceinvestor.com. And today I'm speaking with David Carlin, Head of Risk at the United Nations Environment Program Finance Initiative. And hi, David. It is so wonderful to have you here today.
Thanks, Maya. It's great to be here.
And David is here because he will be giving the opening keynote presentation at our ESG Investment Leader event, Europe, in London on the 2nd of November, upcoming this autumn. And his talk is on the topic of understanding the regulatory roadmap, developments in near-term reform, and is standardization on the horizon in terms of regulation. And so, David, it's a meaty topic. I'm just going to dive straight in. This question is really from your perspective at the UN Environment Program Finance Initiative. What does the regulatory roadmap look like for institutional investors specifically? Can you give us a brief overview, and what are the pain points here that you're seeing?
Yeah, so it's a really timely discussion because just over the past several months, we've seen a lot of movement in terms of the regulatory landscape. I think most notably, in late June, we saw the release of the International Sustainability Standards Board, their disclosure S1 and S2. S1 is a more general sustainability one. S2 is specific to climate. And the focus there really is to provide supervisors, but also actors with a clear way of discussing and disclosing the topics related to their sustainability. And we've seen then a lot of pickup as well from European regulators, the imposition of the Corporate Sustainability Reporting Directive, or CSRD, for those who are involved in sustainable finance, the Sustainable Finance Reporting Directive, the SFDR, that really focuses on how funds are labeled, as well as the composition of them. And so we see that. We also see waiting for the SEC to release their expectations for investors in the US. This really is a very dynamic space, and one where expectations are rising on those that are filing, but also on those that are making use of this information in order to understand how the market, as well as those companies they're involved in, are positioned.
And do you see, I guess, what do you see as being the main struggles around sort of getting the frameworks in place, and how can they be addressed going forward, let's say? What are you expecting in the next few months?
So I think there's going to be a number of teething challenges for many of these regulations that have gone from voluntary to mandatory. Of course, the ISSB, the International Sustainability Standards Board, provides guidance that then can be adopted by supervisors and thus made mandatory by that enforcement action. And I think for institutions that are familiar with things such as the Task Force on Climate-Related Financial Disclosures, TCFD, there's a real need to think about where the gaps are in their current work, in their current analysis, and to begin filling those in. So I see that from the industry perspective, but I also see on the regulatory side and on the stakeholder side a need to think about interpretation and how we understand and how we contextualize the reports we're receiving. Ideally, they will be more comparable, they will be of higher quality, but at the same time making sense of where an organization fits within its industry, where it is in terms of mitigating its risks and taking action on opportunities. Those are going to be things that we still are looking for yardsticks to measure, and we're still thinking about where leaders and laggards lie on that basis.
I mean, I've also been hearing a lot about sort of the shift to interpretation lately, which seems to be a main concern, at least amongst insurers or asset owners. But how would you say that, the gaps in sort of the current analysis have changed, let's say from, I don't know, a few years ago to where we are today?
So I would say that it's gone pretty much from a dead stop a few years ago, in the sense that I would say the exercise was wholly on reporting rather than on using, to now one where we're beginning to see people think about what the nuances are of these disclosures, how to contextualize them. I don't think we're at a stage of maturity in this, but I do think, say, the use of emissions data, the consideration of asset-based data and losses due to physical risk begins to give a bit of evidence, as well as the client engagement side, which is, are you speaking to your board about this? Do you have a transition plan? What's in that plan? These things are beginning to be considered, maybe not always in a systematized way, but in the sense that those who are beginning to use the reports are not only starting to ask these questions, but try to classify how this integrates and intersects both with the traditional financials as well as how it may evolve in the future as more data becomes available.
Interesting. You move a step beyond just reporting.
Exactly.
Yeah. And so the other question I had was for insurers specifically and investment teams at insurance organizations, are there any unique issues you see arising specifically around compliance when it comes to promoting transparency, et cetera?
Yeah, I think that there are a couple that I would note that maybe go above and beyond what I talked about some of those teething pains on disclosure. I think on the insurance side, some of the expectations are going to be really getting local and getting specific in terms of the nature of the activities being underwritten, but also in terms of the risks that they may be exposed to. So I think that will bring with it a higher potentially computational and analytical burden, but also one of exploring, as I said, the activities when it comes to the transition side of, are these activities continuing or perpetuating high carbon and climate risky things. The second piece, though, is for investors and insurers when they're in the context of their asset side, thinking about the composition and labeling of products within a portfolio. And I think this is something that hasn't always been explored in as full depth, which is, okay, where are these green claims coming from? Is there really impact behind those claims? Is this simply exclusions based, or is there a positive effect? And how do we begin to measure and consider that effect in the context of, if we want to call this a green fund, if we want to say that we're having this impact on that asset side, what does it actually look like? So I think that's where you're going to see a bit of pressure, and that's where guidance from the SFDR and others are going to be, most telling and most relevant.
I mean, well, the first thing is that I'm interested in hearing more, not now, but about the computational burden, and hopefully we'll get to that in your talk in November. But the other thing I was going to say is, do you feel that there is sort of a fundamental difference in how people are thinking about what actually a green claim is composed of, or what is actually underlying that?
So I think that there's definitely been a change from what was more surface level several years ago to what was then more about the overall company to now really getting into the impact. And I think stakeholders are a lot more savvy, civil society is, and supervisors are as well, to say, we can't continue to call this transition finance if it's not actually promoting the transition. We can't go on calling this a green fund if it's contributing no additionality toward our environmental objectives. And so I think that that bar has been raised higher, as it should have been, but also I think the evidence of claims needs to be deeper. And that's a place where institutions, I think, are figuring out, how do we evidence impact? How do we evidence additionality, meaning that it's not just that we're moving something around the system, but that we're actually contributing positive growth because of the capital that we've committed.
Yes. I mean, and where do you see this headed, let's say in the next 5 to 10 years? How do you envision the future of regulation in this space, and then the sort of impact on investment decision making?
Yeah, so I think looking ahead, what I would presume to be the future is more rigorous impact assessments on a variety of different claims, but also on the activities themselves. I would also think that firms will be a lot more thoughtful in terms of how they classify, and I think classifications themselves will become a lot more descriptive. So what somebody sees is, rather than just the name on the tin, what are the ingredients in it? And I think that will be something that investment analysts who are looking to purchase a fund, and even potentially retail investors, will see with quite high degrees of interest, which is, what really is in there. And I think you'll see more people doing that work. I think you'll also see supervisors really asking for more information. And as policies become more stringent, it won't just be a ground of, is this what you say it is, avoiding greenwashing, but also how does this align with a stated national policy objective? And so I think you'll see that role of their mandate become more acute as well.
And then the final, I'm going to throw a final question at you. Do you see, sort of along those lines, do you see the fear of greenwashing becoming less of a motivating factor in some of these, as regulations firm up? Do you see that fear going away at all? Or do you see that as still really prevalent and probably continuing to be so?
I think there will be a continuing prevalence of it because it will take on different forms. I think if you had spoken to people 10 years ago about what their canonical examples of greenwashing were, they would look very different than they would 5 years ago and then today. And so as new innovations come up, whether it's in the sequestration and storage space, whether it's in the nature-based solution space, we have to recognize also that the science is shifting under our feet a little bit too. Certain things that haven't fully been tested may turn out to be less beneficial or more beneficial as solutions. So I think there is that potential risk of inadvertent greenwash whenever you're on the knife's edge. But what I would say is, I think the kind of simple greenwash of people being outright dishonest, or at least not really doing the homework, I think hopefully you'll see less of that. And I think the regulatory expectations will do well to drive much of that from the market.
I mean, that's a really interesting point, just that, as regulations sort of become more concrete, the definition of greenwashing will probably become more complex as well. So I'm excited to hear your talk in November. And yeah, thank you so much for those answers. It's all we have time for now. But if you want to hear David speak more on the topic, he will be giving the opening keynote presentation at the ESG Investment Leader Europe event, which is again on in London on the 2nd of November. And just to remind you, his topic is on understanding the regulatory roadmap moving forward. What are the developments in near-term reform? And then this sort of wider question of, is standardization on the horizon, and how can it be achieved? So if you are interested, you can find more information at europe.esginvestmentleader.com. And again, thank you so much for your time and insight, David.
Great. Really a pleasure to